And here we pivot a bit more international. We want to look at OSPs, or official selling prices, first, because one of the things that we were talking about was when you looked at what Saudi Arabia did, they had a huge surge in pricing in terms of their OSPs, where they essentially set it at north of $9 in terms of above Oman, Dubai. And when you looked at that, you're like, all right, well, the spreads market is weakening a bit. So you're essentially telling people that you don't want to sell excess crude. And we saw the typical term buyers take the bare minimum, leave whatever they could, and that increased the amount in floating storage. And one of the things that we had said is floating storage was going to be a good gauge for how is Saudi Arabia going to position themselves, or I should say Saudi Aramco, as they head into the June pricing. So especially after they did that, when you looked at the spread between Dubai and Brent, it was at north of $11 on it, closer to 15. But then all of a sudden it was already starting to weaken, and then it had a big drop, and it no longer made any sense because then the spread was about $4. So it was very expensive to buy from Saudi Arabia and from the GCC in general. So here you can see that they've reduced pricing. They've taken it down by almost $5 from Saudi Arabia, looking at from the Middle East into Asia. Kuwait followed suit. You had a very similar drop when you look at from Kuwait into Asia. But even when you see this drop, you're still at record OSPs. So it's not that you're going to get this big surge in shipments. It's just you're getting a bit closer to where the market is instead of being well above the market at this point in time. And we'll talk about what that means over the next few slides. So when you look at what Saudi Aramco, they cut to Asia, Mediterranean, Europe. They kept it flat for the U.S. And Kuwait essentially followed something very similar in terms of into the Med, into Europe, into Asia, with Asia seeing the biggest cut. But it's important because when you look at what is typically quoted, which is the Saudi light into Asia, it's important to look at, well, where's pricing? Well, this is looking over the last 10 years, and you get an idea of where OSPs are. So yes, it fell. It was at record levels for the last 2 months. And now this one coming through, it's fallen, but it's still at a record level. It's still elevated versus normal. And it's because of what is happening in the market, especially when you start looking at Russia. You have captive buyers. And if you have a captive buyer, well, you're going to try to get the pricing that you need. And then when you look at where we are on the Brent Dubai spread side, you're at about just around $5. So here you're just a little bit cheaper than where Brent is coming in against Oman, Dubai. But it's just a matter of, okay, well, where is that backdrop? Is it what's insurance, what's shipping? Where are you flowing to? Because again, days on the boat is going to adjust your total cost. But still a movement in that direction, because again, as we said when it happened, we thought that number last time of north of $9 just didn't make much sense. And here's kind of that correction. And to be honest with you, we were expecting something around this last month. And so this is where we really kind of expected this would just be pretty much a carryover from where things are. And this is where we sit today. So now when we start looking at the China super tankers, you've seen it drop off. And one of the things, because somebody asked me, I think it was either on the YouTube comments or in Twitter, they're like, well, what is this chart showing? Like, is this, why, if they're in a lockdown, do they have so much crude targeting the Chinese markets? And it's important because this is looking at what is being flagged. So if I'm a boat that essentially leaves, let's just use Saudi Arabia for an example. So it leaves Saudi Arabia and just left. A lot of times they'll put where their destination is, and if the destination could be put into as a port in China. So actually, this is probably a poor example because you can't actually resell. So let's just say Nigeria. Okay, so if they're leaving Nigeria or if they're leaving Angola, they have to put at where their port that they're going to. Now along the way, they can resell. They can say, okay, well, so Chevron's offering me $1 better to go to the Gulf of Mexico. I'm going to resell to there. So just because it's at an elevated level doesn't mean all of these boats will show up. It just means that as of right now, if you gauge every boat in the ocean, at least supertanker crude imports, if I gauge every boat, how many of them are targeting China? And that's what this is looking at. So you get an idea of what is being targeted. It doesn't mean they're all going to show up. A lot of them will, because there's term contracts where you have destination clauses and you're not allowed to resell. But again, it just gives you an idea that not all of these will show up. So then when you start looking at, well, why is that? Well, China, Shandong Independent, or the teapots, continue to be at a seasonally adjusted all-time low. So we're still seeing a lot of pressure on refiners. There's really no impetus for them to increase given the lockdowns, given the slowdown in demand. And as we've talked about on the Econ show and in our insights, you continue to see a lot of pressure on that government and the underlying consumer. So then when you look at total oil on the water, we're at not only a 2022 record, but if you take away 2020, there's a record amount of crude on the water. And it's because of what's happening with Russia, where most of these sailing times are much longer. So if you have a longer sailing time, you're going to have more and more boats that are being consumed in order to move this. And instead of it being, say, 15 days, it going to 35, well, you doubled the sailing time. And by doubling the sailing time, and that's just from port to port, then you have to turn around and go back. So as you continue to increase miles per ton, you're going to absorb a lot of additional boats, which is just going to put more and more crude on the water, because we're going to see more crude in transit, which is what we're seeing. So obviously, if you take away 2020, we're at 2022 highs and progressing higher when you look at the amount of crude in transit. Now, again, the crude that's in transit will go into floating storage depending on timing. And as you had West Africa aggressively trying to sell crude, trying to bring down their floating storage, that was also an additional push in terms of crude in transit, because it's going from floating storage into transit. We're seeing, again, Urals, more crude getting pushed from into the market on the Urals front as they tried to move some through. And then we still had some of that crude going from floating storage into transit, accounting for some of that drop. And then we've also had some of that crude coming from floating storage to land storage. So again, that's the different pieces. That number that line is touching right now is 2016. And if you remember, back in 2016, 2017, the Middle East had a huge spike in floating storage, which is what that comp is capturing, is that Middle East side. So as we've said before, through 2022, we expect floating storage to stay fairly flat. The comps get harder than easier. It's something where we just think that for 2022, we're just going to see a very stable, flatlining piece, just based on where we have a lot of logistic problems. There's still some of these concerns around demand, which again is going to put more in floating storage. Now, when you look at U.S. crude product exports, we had an increase of 106,000 barrels a day for gasoline. That's 367,000 above the 5-year average. Again, this is that sucking sound that you're hearing when you're getting a lot of that pulled out of storage and into the market. A lot of that is coming into the export market. Distillate, an increase of 168,000 barrels a day. That's 212,000 above the 5-year average. That's something that's going to start to slow down, still be above the 5-year average, but start to slow as demand flowing into, not that Europe doesn't need more, because it does. It's cheaper to get it from other places. So we're going to see some of that drop out of the U.S. And then when you look at propane, propylene, 228,000 above the 5-year average, and we do expect that to continue to grind back up and set new records. Crude had a drop of 695,000 barrels a day. Again, there's a lot of that timing. Last week, we thought we were going to see we said we were going to see a drop. We got a little bit of a drop. Now we got a bigger drop. Now we expect to see a little bit of that bounce. And again, it's a lot of that is driven based on just logistics and the problems that we have, the limitations we have at the coast on the speed of getting it into the market. Here you can see gasoline holding seasonally adjusted highs, just hanging out at the top, continuing to be an underlying just an elevated amount of crude going into the, gasoline going into the market, trying to, again, balance our consumption, as our storage, because we need storage available in order to push more on the distillate front. Then when you look at distillate fuel exports, right back to the highs, again, we expect this to remain elevated, as we said 2 weeks ago, that if we're not setting new all-time highs, we'll be just above the 5-year average. Now, as Europe buys a bit less, we'll tighten that a bit, and we'll be just at, let's just say, the top end of that cloud, or just above the 5-year average as we go through the next few weeks. Ethane, again, just going to continue to just set records just based on where the flows are, and then the flows going into the international market. Crude, again, as we said last week, we expected to see a drop. We had another bigger drop. Now here we expect to kind of hang, as we've been talking about, that 4-week average at about that 3.4 million barrels a day. We had one last surge at 3.6, but now we'll get that pullback just given where they are to about 3.4 million on the 4-week rolling average. Propane, again, just above the 5-year. We expect it to be well above the 5-year or at a new record, and that's just going to continue based on pricing and the demand in the international market. Now, here's, I think, an important piece when you look at Brent Dubai, especially when you start looking at where's pricing, how is pricing functioning. And we've had some of that bounce off the lows, especially when you look at it against the just north of $5. And that's where, when you look at how OSPs are going to be set, and how when you think about the GCC nations, i.e. Saudi Arabia, Kuwait, Dubai, or I should say the UAE in general, you're going to try to position yourself. Okay, well, what is pricing? How are prices being set? Where should we set them going forward? Because you want to be able to sell crude, again, at a stable rate. So right now we're at about $7.94. So at this point, the OSPs coming into June, obviously not in May, but next month, you're starting to see things get a bit more competitive, especially when you look at crude coming out of Saudi Arabia and Kuwait, and likely the UAE will follow suit. They could try to undercut a bit, maybe bring it a dollar lower, still make a ton of money, but be the preferential seller in that market, which is some of the things as well. Now, when you look at refinery margins in Singapore, again, still gangbusters. We don't see that changing, just given where we sit on those levels of flow. Off the highs, but again, the gasoline, the distillate market still remains robust. It's still carrying a crack. Costs are still remaining elevated. Natural gas in the U.S. is $7.60. LNG is still expensive. Costs are up. So again, you're going to see that crack maintain some flows. Now, I think the number here is wrong for Libya, just because there's still a lot of problems. Excuse me, when you're looking at the flows that are being expected, they're at about 600,000 barrels a day in production. They're pretty close to an agreement to bring some of those additional fields online. So here, I would bet that the 2 is wrong, and that we should be at about 374,000 barrels a day based on what I see in the system as being scheduled. So it's just how quickly they can bring this back. We do believe that Libya will be able to export about 1 million barrels. But again, there's still a lot of issues that need to be fixed, and Libya is continuing to be one of those slow spots. Norway continuing to, again, remain elevated. Angola increased a bit in June. Nigeria is something that we expect to be just about 1.5 million barrels a day, not too much north or south of that. As Russia, and if you think about what we showed at the beginning of segment 1, they're averaging about 4 million barrels a day. But right now, you can see here, they're averaging actually 4 million barrels a day going offshore, but they have scheduled about 4.45. So again, they're still getting stuck with some of this, and they need that to clear, because if they're not selling it into the market, it's being left in storage. And that's where you're going to continue to see some of those pressure points. We covered this on Friday, and then the week before, we had some decent cuts in Angolan pricing and Nigerian pricing. They had cut about another 30 to 40 cents, depending on what it was, crossing at about $1.10 below what dated Brent is, and that was done just to kind of clear the slate. We haven't gotten any new pricing, so there's not much to say on the pricing front yet. Here's when we look at what's happening in Europe. We're now back above that 10-year average, 9-year average. When you look at where stocks are in Europe, and we don't expect it to continue to grind up, because here you can see it's above 2020 levels. It's just we expect it to hold the average just based on refining utilization rates, where the processing is, and just where things sit from in the European theater. Gasoline had another build of 27. Then you look at gas oil, had a small build of 84. Fuel oil had a big build of 116. And the build in gas oil was really because we had a lot of imports hitting at once. You can still see it's still at a very bullish position in terms of pricing. They should start to see that grind back up, but again, it's going to be a grind. We're not seeing this huge surge of a wave of gas oil showing up. So again, that remains a positive for pricing. But on the gasoline front, you can see we're at 2022 highs, and we're at on seasonally adjusted, the highest on record. And we do expect to see a big increase in exports, especially given the position that the U.S. East Coast is in on that front. Fuel oil, another big spike. This is going to be managed based on, is it going to be recracked or is it going to be exported into the east of Suez market, because you're starting to see more demand on the fuel oil front as they try to replace some of the low and light sulfur given pricing. And here's why. Because when you look at Singapore had a big build of 39.5 to 41.4. Still below the 15, 17-year average. But again, we expect it to be right at that average in terms of holistically, driven by the elevated amount of light distillate in the market, in storage, and residual fuel. Because middle distillate, now you had a build in light distillate, you had a build in residual, but you had a draw in middle disti, bringing you to just epic lows, which is again keeping that pricing, supporting the Singapore crack. So when we first look at what is happening on the light distillate side, you can see that there were only 2 years higher, and one of them was 2020, the other was 2011. So again, you're still seeing a significant amount of light distillate that speaks more to, again, trying to create distillate, throwing off gasoline, and a bit of that slowdown in gasoline purchasing as we come to the other side of Ramadan, which is typically you get some big purchases ahead of that. On the middle distillate side, crashed through the floor, the lowest of 2022. Again, just continuing to be at a very, very low and bullish level for production, as well as just underlying pricing. And then here, when you look at residual and heavy disti, we expect to just kind of hang right around that 15-year average. And that's going to, again, that the only way that's going to accelerate further down is if we get a bigger pivot away from light middle distillate and into the heavy front. Fujairah also reflected what we've been talking about, especially for Singapore. So there was a build of about 1.43 million barrels, and it was really driven based on light distillate. Now, middle distillate had a little bit of an increase, but you're already at record lows, so you're dealing with slight builds on record lows, where light distillate had a sizable increase. The increase was 1.268 million, with stocks breaching 5 million barrels for the first time since the end of March, just to give you an idea of the movement. The East of Suez gasoline market continued to see some support, with demand in the Middle East firm due to an increased travel during the post-Ramadan period. Again, people going back. But that is, again, going to wane, and it's going to put a little bit more pressure, which is just going to put more product in storage. Middle distillate, on the other hand, it rose 363,000 barrels on the week, but that's still massively low. Gas oil market was seen of easing a bit just because of pricing. People are saying, look, if I can avoid it, I'm not going to spend it because it's super expensive. And that's something where that'll put a bit more into storage. But because of that pricing, where heavy resid had a drop of 201,000 barrels and it held above 11 million for the fifth consecutive week as deliveries of bunker fuel continue to fall off. And that comes back to what we've been talking about with just the slowdown in just general trade and just movement of goods, which we think persists. Now, when you look at the Brent time spread, we're at $1.32. We just, as we've been saying, we expected to just kind of hold between $1.30, $1.50. Based on where pricing is, we don't see that changing in that period. Asian floating storage, you can see here, we're right at the cusp just below 2022 highs, and we expect this to remain again flat. China's trying to resell or offload some of their excess that's sitting on the coast, so that'll go from floating storage back into transit. But you can see here, there's still more cargo showing up. It's going to be a matter of how quickly they can clear the logistical nightmare that's on their coast, which is going to take some time. So as we've been saying, the comps got a little bit harder with 2021, 2020, but then 2021 comes down and that'll comps will get easier. And we just think that 2022 holds firm and flat. North Sea, again, we had a little bit of an increase in buying and some of that heading actually back onto the European continent. And we expect this to remain at the low end. West Africa, as we were saying 2 weeks ago, and again, this past Friday, we saw just steep discounts, and again, that was to clear some of that. So we had crude going from floating storage into transit. We expected just to stay at the higher end and remain at either near or at all-time seasonally adjusted all-time highs. And here you can see in the Middle East, and again, remember when we were talking at the beginning of this, looking at the total storage situation, 2016 was where we had a huge amount on floating storage in the Middle East. But then when you take that away and you look at 2022, we had breached the high in comparison over the last 5 years. If we've come down a bit, but you can see that floating storage is still elevated, which I think really helped prompt some of those additional cuts that we saw on the OSP front. And then Europe, floating storage is going back up. We expect that to get onshore, and we expect to see the European the crude situation stay fairly firm and right around those averages. So that's what we have for you today. If you have any questions, please feel free to reach out. We always love the back and forth. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.